Hello everyone. Can you guys hear me? Please send me a chat there so I can see. Wonderful, thank you very much. All right, so let's begin. Thank you so much for your feedback. All right, so welcome. We are starting the 5-day Elliott Wave Masterclass. This is the foundational Elliott Wave curriculum that takes most students several months to complete and perhaps thousands of dollars in courses to piece together. I'm delivering it in a distilled form so you can have it in 5 days for free live this week. Before we start, I want to tell you that the class will be interactive. So please feel free to ask your questions as I'm explaining whatever subject at hand. And before we begin, I'd like to know where you guys are calling from, and also, have you ever started learning Elliott Wave? Are you struggling to learn Elliott Wave? Are you struggling to apply Elliott Wave? What is your experience with Elliott Wave at all, or you never heard of it at all? So I need to have an idea so I can teach you in the proper way. Greetings and peace to you as well. So tell me, where are you calling from? And please let me know if Elliott Wave is completely new in your technical analysis arsenal. Can hit it now. Not so sure what that means. You're calling from Mexico. Fabulous. Well, I'm in Germany at the moment, so we're very, very, very far away, but wonderful. Glad to know. USA, great. Elliott Wave is new. Okay, so you are up for a really pleasant surprise. Calling from Turkey, fabulous. And Elliott Wave is new to you as well. Oh well, okay, so I have to concentrate in new material. I'm learning Elliott Wave through YouTube videos, but it can be confusing. Indeed it can. We have people from Morocco, the Netherlands, brand new to Elliott, South Africa. Wow, we have a lot of countries here. That's wonderful. Thank you so much. Well, that's fabulous. Let's see if anyone can help. I mean, I understand you guys are not very familiar with Elliott Wave, but are you familiar with technical analysis? Do you know what technical analysis is? Could anyone give me a definition of what technical analysis is? And I would like to start there because there is a huge confusion with the idea of technical analysis. People think technical analysis is just a bunch of indicators and that's technical analysis, and that's not the case. Welcome from Hong Kong, and I'm in Wilhelmshaven. I live in a very small city in Wilhelmshaven in the north of Germany. Yes, so technical analysis is a method of forecasting the direction of financial market prices through the evaluation of historic price. So basically, notice that technical analysis is a method of what? Of forecasting. Forecasting is the intention, is the the whole purpose of technical analysis is to forecast the direction of financial markets. Now, the Elliott wave principle is, without a doubt, and I'm sure you will find that to be the case as well, is the most powerful forecasting tool ever created. Hence, it is arguably that most people, most traders, if not everyone, should use the Elliott wave principle as the most important tool that you will have in your arsenal of technical analysis, because it is the best tool for forecasting. Obviously, the next confusion that people have, or rather the next argument, is that people believe it is impossible to forecast. Somebody says Elliott wave seemed to be only for higher time frames. Well, now you are going to discover during this week that that is not the case at all. Cavazos David says, yes, technical analysis is how charts are studied to recognize the price movement. That is absolutely correct, but with a primordial purpose of forecasting. Of course, as I was saying, many people argue that it is impossible to forecast. And by saying that, seriously, this is pretty much the same as to say that, or pretty much deny the entire discipline of technical analysis that has developed and improved for more than 100 years. First, with Munehisa Homa, I don't really know if I'm pronouncing that correctly, and that was in the late 1700s. He's the one credited with inventing candlestick charts. And then, of course, with Charles Dow, everybody's familiar with Charles Dow, at the end of the 1800s, and thereafter, then with Elliott, Ralph Nelson Elliott, in the 1930s, when he actually started improving upon the Dow theory. So it has been an evolution, and that evolution pretty much culminates with the Elliott wave principle. So let's discuss if it is possible to forecast. I have a chart here that I really love showing to people. In pretty much all my courses, I always show this chart because it is a chart from the Dow Industrials from 1933 to 1948. The upper line was the forecast made by an analyst by the name George Marechal at the request of President Roosevelt in 1933. President Roosevelt wanted to know how the stock market would perform in the near future, and Marechal, the analyst, made a 15-year forecast for him. Now, here is the really amazing thing. The lower line is the actual performance of the Dow during the same period. The reason why I like so much showing this chart is because it would be difficult to imagine a more precise prediction for a 15-year view of the future, particularly when World War was not even in the horizon at the time of making this forecast. When I show examples like these, many people tell me, I would say in frustration, I don't want to forecast, I just want to trade. And that makes me smile because they say that as if forecasting and trading were two separate things. And perhaps it is because most traders see them as two separate things that most traders lose money. The truth is that the success of any strategy is predicated upon three factors: forecast, timing, and trade management. Most people concentrate in timing. You know, when you go to a channel and you see somebody saying, well, you know, when the 9th exponential moving average crosses the 13 simple moving average from below, and the 13 moving average is above the 50 weighted moving average, then you can buy. Well, that's not really a strategy, you know. That's timing of when you enter the market. And certainly, timing is important because, as I said, the success of any strategy depends upon timing, but also upon forecast and how you manage that trade. In other words, why is it that all those strategies fail so often? And sometimes they work, and sometimes they don't. And of course, people get all frustrated because, well, they say, well, you know, I'm using the MACD, you know, and the MACD sometimes works fantastically, and sometimes don't. So that frustrates many people, right? And then they say, well, no, it's not possible to trade with the MACD, so let me move to the awesome oscillator. And then they start using the oscillator, and they have the same experience. Sometimes it works, sometimes it doesn't. And then they say, well, you know, let me learn the RSI, and they start using the RSI, and the same thing appears. Well, it is because they are only concentrating on timing and dismissing altogether the most important aspect of that equation, which is a three-component equation, which is forecast, timing, and trade management. But if you don't forecast first, those let's say simplified strategies like buy when prices are above the trend line, or buy or sell when prices are below the moving average, or whatever it is, if they don't have the proper forecast, well, they will work when you manage to be with the trend, but they will not work when you didn't make the forecast and you are against the trend. If your forecast, if you fail to make the forecast, or your forecast was wrong, then of course that strategy will mean nothing. Now, the same strategy will be extremely powerful when used within the context of the forecast. So, I believe it is clear, at least very logical, that our ability to win in the markets depend on being able to at least anticipate what the market is going to do. And people do that, well, as I said, they do that with indicators, with oscillators, with cycles, with seasons, with trend lines, with moving average, whatever. The problem typically is that they do that without context. So, no matter what form of analysis it is used, even if you use fundamental analysis, you are attempting to anticipate what the market is going to do. The premises may be different, and since you are here to learn Elliott wave, let me explain the premise of the Elliott wave principle, because it is very much different from what we are accustomed to. The premise of the Elliott wave principle is that investors have an unconscious impulse to herd. In other words, they will follow the actions of others, regardless if the others are on the right side of the market or if they are on the wrong side of the market. So that is known as crowd behavior. And crowd behavior trends and reverses in recognizable patterns. And it is precisely those patterns of crowd behavior that Elliott called waves. Okay, so Elliott identified 13 different patterns that cover all market conditions. And amazingly enough, in the past almost 100 years, no new pattern has been identified. Think about it. Only 13 patterns are required or necessary for you in order to forecast any market with precision. It's not a lot to ask. Huh? So in today's lesson, I only want you to learn the two modalities of wave development. So let me go back to my chart here, because here you will see the two modalities. Basically, from these two modalities, we will have the entire wave principle. And those two modalities of wave behavior or of wave development are basically motive and corrective. So two modalities, motive waves and corrective waves. The 13 patterns that we discussed fall under either motive waves or corrective waves. Motive waves are the ones that go in the direction of the main trend. Corrective waves are the ones that move in the opposite direction. So what do you think? Are you ready to start learning those 13 patterns? If so, let's begin with what we have right in front of you. This is the chord pattern, the chord structure. And as I told you, was in the 1930s when Ralph Nelson Elliott made that, I would say, remarkable discovery. He realized that stock market prices were not random. They were actually recognizable, and they always repeated the same type of patterns. So what you see in front of you is the main core pattern, one that repeats itself over and over again in a fractal manner. This represents the Elliott wave principle and everything there is to learn about the Elliott wave principle. This will become your main trade setup, as you will discover in the next 5 days. At the heart of the Elliott's discovery is a simple core structure, a 5-wave move. You can see that goes from here, 1, 2, 3, 4, 5. Actually, let's put some numbers there so you follow it easier. 1, 2, 3, 4, and 5. And then 3 waves down, okay, that we typically label not with numbers but with letters. And I will explain to you why. The reason why we label these with numbers is because they are the part of this core pattern that is called the motive phase. In other words, these are the motive waves. And this ABC, the one that are moving against the main direction of the trend, which is in this case up, they are the corrective phase. And so the motive phase is labeled with numbers 1 through 5, 1, 2, 3, 4, 5, and the corrective phase is labeled with letters, A, B, C. You will discover later that there are other letters that we use sometimes, but at the moment, for the core pattern, this is all we need to know. So he observed that this 8-wave cycle is not isolated. It is actually the building block for larger structures. And those larger structures resemble the same basic pattern. In other words, the market builds itself in fractal layers. Each 8-wave cycle combined with others to create waves of higher degree, repeated endlessly across time frames. This fractal nature explains why the wave principle works equally well whether you are analyzing a 5-minute chart or a multi-year trend. That to respond to someone who just said that the Elliott wave principle only works in larger time frames. That is not true. In fact, it works in any time frame. It could work in a 30-second time frame if you wish. So basically now we have this 8 cycle. Let's do it with a smaller, let's say a smaller drawing. Let's say that it goes like this: 1, 2, 3, 4, and 5, and then A, B, C. So that would be the first core pattern, right? And as I said, that would be the building block for larger structure. And how will that do? Will that happen? Well, it will combine or will repeat itself in the same way. Again, 1, 2, 3, 4, 5, A, B, C. And then, well, it will repeat itself again. I think I destroyed I destroyed the. Okay, so let's see if I can bring it back. Yeah, okay, so let me do something. Let me erase this and draw it again in a better way. So here we have 1, 2, 3, 4, 5, A, B, C. That would be the core pattern, the big one that we have here, right? And so the next one will be that this pattern, this 8-wave cycle, will reproduce itself and will continue 1, 2, 3, 4, 5, A, B, C. And then this pattern will reproduce itself to form another one: 1, 2, 3, 4, 5, A, B, C. And this pattern will reproduce itself to form another one, and that ad infinitum. So basically, this is what it means, the fractal nature. Okay, so let me put it in a different way. I'm going to erase this one now. And let's see if we can use this one again. Basically, what we have here is the 1, 2, 3, 4, 5, and ABC. But now we know that this is the first part of a much larger one, as we did in the previous drawing, right? But that also means that for this one to be that one, it also develops in 1, 2, 3, 4, and 5. And then A, B, C. And then the next one goes exactly the same: 1, 2, 3, 4, 5. And then the correction will be A, B, C. And then again 1, 2, 3, 4, 5. And so forth and so on, right? So when we see this one, this small one here, or this small one here, we will know that this also develops in 5, exactly like that, and this develops in 3, and this one in 5 again, and this one in 3, etc., etc. So it would continue like that. And in order to differentiate those, we use different degrees. Okay, so let me now erase all this and see if we could start with the degrees to make them a lot easier for you. So let's say that we have the 1, 2, 3, 4, 5, the beginning, 1, A, B, C. Okay, so we know that this is the first one. So we will label it as a 1. And this would be a 2. Now, we know that it reproduces itself and will be 1, 2, 3, 4, 5, and again A, B, C. So now will be the 3. And this would be the 4. And now we have another 5-way move. And this would be the 5th. And then what can we expect from here? Well, we can expect that after every 5-way move, we will experience an ABC, as we saw here, right? 5-way move up, 3-way move down. 5-way move up, 3-way move down. 5-way move up, then we expect 3-way move down. So now we have here 1 degree, right? But at the same time, we already know that this is actually also the beginning of something much larger, because this 1, 2, 3, 4, 5 is exactly as this 1, 2, 3, 4, 5. And so this 1, 2, 3, 4, 5, 6, 7, 8 is exactly as this 1, 2, 3, 4, 5, 6, 7, 8. Therefore, this one here is also a 1 of a larger degree. And in order for us to differentiate the degrees, then we will call this a 1 again, but we will put it in parentheses. Okay, so now we know that this is going to be 1 of a much larger development. Okay, and obviously this would be the 2 of that much larger development. And if we had something like this, what do you think we can expect thereafter? We know that after 5 waves here, we can expect a 3-way down. We know that after these 8 waves, we can expect another 5 waves up. And we know that after these 5 waves up, we can expect a 3-wave down. And we know that after this 8-wave cycle, we can expect another 5 waves up. Right? And now we know that after these 5 waves, we can expect a 3-wave down. And so what do you think we can expect after this 1 in parentheses and 2 in parentheses? Anybody can answer that? Nobody's daring? Well, it's very simple. What comes after 2? Well, it comes 3. Exactly like here came 1, 2, and now a 3 in that direction. The same thing happened here. 1, 2, and now we would expect a 3 going in that direction. The only difference is that the 3 will be of a larger degree. In other words, it will be a 3 in parentheses instead of a 3 with single numbers. I hope this is making sense. Yes, Joe says another 5 waves up, and that's exactly the case. And let me put it this way. The exact same thing. Just a second, let me try to see if I can erase this. No, not like this, maybe like this. Yes. The exact same thing will happen if we had a downtrend. Let's say that we have down, up, now we have a lower low, and now we have a higher low, and now we have a lower low, right? So we have 1, 2, 3, 4, 5. What does the wave principle tell us that happened after 5 waves? Well, it says that 3 waves in the opposite direction will occur. Then we can expect an A, B, C. And now we have the 8-wave cycle here again. And then what can we expect that happened after that 8-wave cycle? Well, we have another 5 waves down, right? So we will label this as wave 1, and this will be a wave 2. This will be obviously a wave 3. And then what can we expect after these 5 waves? Well, 3 waves up. Does it always happen? Yes. Every time the market goes through the cycles of 5 waves, 3 waves in the opposite direction ensued. And that is exactly I would say, the basics of the wave principle, and what it makes it so simple and so easy and so practical. Because when you are able to identify those 5 waves in a particular direction, you know that after those 5 waves are complete, now you're going to get 3 waves in the opposite direction. And after those 8 waves are complete, now you're going to get 5 waves again in the direction of the main trend, and that would complete the 5-wave cycle, which is going to make it again. This was, let me put this again. This was 1, 2, 3, 4, 5 of this degree, and now this makes it the one of a much larger degree, right? The one that we call 1 in parentheses. And I think by now you understand clearly the concept of the 8-wave cycle and the different degrees. So I want to show you what those degrees are. There are multiple degrees. Okay, if you have a trading view thing and you go to the numbers of Elliott wave here, let's say you call them 1, 2, 3, 4, and 5. If you click on those numbers, you will find here the degree. The ones outside parentheses, the single numbers, are called minor. But if we transform them, let's move this to the side so you can see that. If you transform these minors into intermediate, they will have the parentheses. So that means a larger degree. And there is still a larger degree with primary, and they are in circle. And there are more degrees like cycle, supercycle, grand supercycle, submillennium, millennium, supermillennium, etc. We don't want to bother with all these. I do want you to learn primary, intermediate, and minor. So far, we have been discussing the minor, which is the single number, as well as the intermediate, which is the number with the parentheses. So now let's do more. Let's do again 1, 2, 3, 4, 5, A, B, C, and another 1, 2, 3, 4, 5, A, B, C, 1, 2, 3, 4, 5, another A, B, C, right? So now we're going to label this. How are we going to do that? Well, we're going to say that this is a 1, 2, 3, 4, and 5, but since these are primary degree, we don't want them to be that large. We want to be the smaller ones of the entire thing, of much larger. So we are labeling this as minor, okay? And then we can do the exact same thing with this one. 1, 2, 3, 4, 5. And of course we can do the exact same thing with this one. 1, 2, 3, 4, and 5, right? So now we have the internals of the entire thing labeled. So now we have to label these 5 legs here as a 1, but a 1 of a larger degree, because we know that, let's make a larger drawing. We know that this is a 1, 2, 3, 4, and 5. Remember? So we can actually, let's move this to the side, and now we can label those and say, well, that should be a 1, 2, 3, 4, and 5, but of a larger degree. That would be the intermediate. You see it? So now let's eliminate this one, and then let's put the one where it corresponds. 1, the 2, the 3, the 4, and the 5. So again, we have those 5 waves up, and that means that this is the one of something else, right? So in that case, we're going to label that as a primary. So let's do that again. Let's label this as a 1, but not an intermediate. Let's make it a primary, a larger degree, right? That would be the primary 1, and this would be the primary 2, and then we would be expecting, obviously, a primary 3, 4, and 5 up. Makes sense, right? The way to remember this is very simple. You know, if you go from the low degree, let's say from the, not the low degree, but from the lower degree, let's say you start with numbers like that, single numbers, and then you know they are the, let's say, the components of a larger degree, okay? And that larger degree would be the same number but with parentheses. And so we know that this is going to be the component, the larger component of still something much larger, and the way to make it much larger is that those parentheses get together and make a circle. So single, parentheses, circle. That makes the entire thing much easier to remember. And remember, the names are simply minor for the single numbers, intermediate for the ones that are in the middle of the parentheses, and primary for the ones that are in circle. Now, we see that, so far, we see that we have said that these cycles of 8 waves reproduce themselves. And so whenever we have something, even if they are in the middle, we could pretty much predict what the next move should be, right? So if we have 1, 2, 3, 4, 5, and A, B, C, we can expect that from here we will have another 1, 2, 3, 4, and what's coming now? Well, obviously, right? We would be expecting that from here our forecast will be up, higher, for a 5th wave. A 5th of what? Of what? A 5th of a 3rd wave, because this is 1, this is 2, and this would be the 3rd. But we're expecting the 5th one, because we have 1, 2, 3, 4, 5 of that 3rd wave. Therefore, this is going to be of a larger degree, right? So the inside of this will be the smaller of the one in circle. What would that be? Well, the ones that are not complete with the circle, right? Is it making sense now? Hope so. Okay, so now I'm pretty sure you are thinking, all this is just theory. The markets don't behave that way. If I take a chart, I will never find that core structure that you drew there. That's only theory, and so forth and so on, right? Well, what I did was to bring a chart, specific chart, to show you that actually that happens all the time. But I'm going to show you on this chart the clarity of this. this is a monthly chart of stock by the name Etsy. And I think by now, after seeing me, let's say, label so many of those 8-wave cycles, you're pretty much in the ability of labeling this from here to here, aren't you? And I would say before we label it, we want to take a helicopter view. What do I call a helicopter view? Take altitude. Take distance from the chart. Don't try to see what's in here and here. No, just go from the higher view and see, well, from the bottom I see prices are moving up, then they move down, they move up again, they move down, and they move up again, right? You would all agree that this is what we see in that move, right? So let's take this drawing, and isn't this the same drawing that we have been doing? The 1, 2, 3, 4, and 5? It's exactly the same one, right? So now, let's look at, these are the motive waves. Remember, motive waves are the one that we label with numbers that go in the direction of the trend. And then we have the other modality of waves that go against the trend that we label with letters, and we say A, B, C, right? So we know that let's say the waves that move in the direction of the trend here would be, well, wave 1, then it would be wave 3, and then it would be wave 5, right? I think that's all clear, right? This would be the ones that are moving in the direction of the trend. And, well, the ones that are moving in the opposite direction, these ones, are the corrective waves. So we said that motive waves, the one that move in the direction of the trend, typically develop in 5, whereas corrections typically develop in 3, and that we call them ABC. We don't label them as 1, 2, 3. We label them as A, B, C, whereas the ones that move in the direction of the trend, the motive waves, we label as 1, 2, 3, 4, 5, and we call them motives. Okay, so if that is true, we should see 3-wave move to the downside here. In other words, on this chart, we should see that this leg here should be corrective because it's against the main trend, right? So it should be in 3. And we should see that this wave should be in 3 too because it's corrective, it's against the trend. And we should see that this one is also corrective. Then it should be in 3. So can we take a helicopter view and see if this is exactly what happened? Well, let's say from here we see down, up, down. From here we see down, up, down. And from here we see down, up, down. Would you agree that these counter trend moves are all in 3? Let me know in the chat to see if you are following me. And also, now that we are able to identify the motive waves there, the one that go up, that in the direction of the trend, and we identify the one that go in the opposite direction. Thank you, Emil. So now we can say, well, let's label this. we can see 1, 2, 3, 4, and 5. Thank you, Angela. Very nice to see that you're following it. So now we have, well, I think this is very clear, right? We have 1, 2, 3, 4, 5. And we label them like primary, with the primary labels because, well, this is a monthly chart. So now we should be able to label this as an A, B, C, also with the same type of degree. So this would be also a primary degree. So we go here and change it to primary. And now we have 1, 2, 3, 4, 5, A, B, C. And I believe that now you can agree that actually markets do move in the way that the Elliott wave, 8 wave core structure shows. Now, when we were here, we said, well, there are 3 waves moving down. That means that we have pretty much 5 waves here moving up, 3 waves moving down. That means that the next move should be to the upside. So now we can see 1, 2, 3, 4, and 5. And then we have A, B, C. And from here, we could again forecast that the next move should be to the upside. We have 1, 2, 3, 4, and 5. And once that we got this here, we have already 5 wave move up. Do you think we're going to continue saying, well, the market is in an uptrend, so we should go long? Well, no, not when you know Elliott wave, because now you know that the 5 waves are complete. That means that now we're going to expect 3 waves down to ensue. And this is exactly what happened. So from here, we could predict an A, a B, and a C. Okay, so now, well, that's all, like people say always, right? That all happens in retrospect, and, in retrospect, everything is easy, and only you can forecast only when you see it from the past, but you can never forecast when you see it from the future. Well, not after you took this lesson, because now you know that after an 8 wave cycle, what is it that we expect? Do we expect prices to move down? Probably not, right? Why not? Well, because we know the basics of the wave principle, and we know that after an 8 wave cycle, as we have here, 1, 2, 3, 4, 5, 6, 7, 8, we expect this big pattern to repeat and reproduce itself. Exactly, Emil. So that means that from here, we can expect prices to move higher. And this is a funny thing, because you have here a monthly chart of this stock, and you can pretty much know that if you invest your money in something like this, it's going to move above here, right? So right now it's trading at 60 something. Right here would be like 300 something. That means that you can, just by knowing this 8 wave cycle, you can quadruply, what is that word? Multiply 4 times, let's say, just by going here. If it were to reproduce completely, which is what we would expect, we would reproduce that investment exponentially, right? And that's all by knowing the first core structure of Elliott wave. That simple. Now, this I brought simply because I wanted to show you that what I'm showing you with those drawings are not theoretical, and that the forecasts are not theoreticals. These are things that actually happen. Now, we have to dig a little bit more. Why won't it move down? Ask. Well, it's very simple. Because we learn that the core structure of markets, this is what Elliott discovered, right? In the 1930s, that prices move in predictable patterns. And the basic core pattern is this, 8 waves. And he discovered that these 8 waves reproduce themselves fractally. That means that these 8 waves that are here are also here. And are also here. And also here. So after you have 5 waves, always you get 3 waves. And then the same pattern reproducing itself. 5 waves, 3 waves. And again the same pattern reproducing itself. 5 waves, 3 waves. And after you have that, now you again have, just a second, again you have 5 waves, 3 waves. So why would you think that it's going to move down when we know that the pattern is always the same? 5 up, 3 down. After 5 up and 3 down, the next one will be, well, necessarily in this direction. 5 up, 3 down, 5 up, 3 down. At least 2 more times. Why 2 more times? Well, you have it here. 5 up, 3 down. Now you have it again. 5 up, 3 down. 1 more time. 5 up, 3 down. So now, once you complete complete this pattern 2 more times, you have the full structure. And then, well, that probably will be on a yearly or several year chart, right? And then the decline will be in 3, but that would take years as well, because after the whole pattern is completed, just like in this case, this took months to complete. Now it's going to take months for prices to go above this level here in the next 5 up, 3 down. Hope that makes sense. Okay, so now let's dig a little bit further into these patterns, because what we have learned, right, so far, basically we have learned that the basic core pattern of Elliott wave is an 8-wave cycle. An 8-wave cycle that repeats itself fractally. An 8-wave cycle that becomes the building block for a larger structure. And those larger structures resemble the same basic 8-wave cycle. And that's what is called fractal layers. Each 8-wave cycle combines with others to create waves of higher and higher degrees, repeating themselves endlessly across time frames. And it is precisely because of this what we found here as this 8-wave cycle in a monthly chart we would find in a daily, in a weekly, in a 5 minutes. I am a Cameroonian watching from Qatar. Oh, fantastic. I have a problem in where to start counting my wave 1. How to identify the start? Well, that's very simple. You know, the answer is always a lot simpler than people think. When we start learning, the most common question is precisely, where do I start counting, right? Well, would you start counting here? Why? It wouldn't make sense, right? So where do you start counting? You start counting from the bottom or from the top. You start counting from the significant low or from the significant high. I mean, if I'm going to label this, I wouldn't start labeling it from here. That wouldn't make sense. You start labeling it from the extreme. It's that simple. And it becomes simpler and simpler as we go through, right? So at the moment, it's very abstract. And remember that whatever we try to learn in the beginning always becomes very, very complicated, very complex. It appears that it's, rocket science. But after we start getting familiar with it, we realize, it's a lot easier than I thought. If C pass 4, that means trend change. There are trend changes, but we're not going to cover that at the moment because that would complicate the flow of, let's say, the step by step, right? Certainly, what we have here is a high here, a low, a higher high, a higher low, a higher high, a higher low, a higher high. And now we don't have a higher low, we have a low that is lower than this one. That means that the sequence of higher highs and higher lows ended. Therefore, the uptrend is over. And certainly, if prices were to continue moving below here, we would say, well, that ended the cycle of higher highs and higher lows. And now it becomes a cycle of lower lows and lower highs. But the quick answer to your question is, would that make a change in the 5-wave pattern and 3-wave down? And the answer is no. These 3 waves can end here, can end here, can end here. In fact, we'll see if we can cover that next, but these 3 waves for ABC can end anywhere within this structure. As long as they don't go below the low here, these 3 waves are part of a correction for an uptrend, and the expectation will still be up. Okay, so that's a quick answer. Now you're going to tell me, but then there's never trend changes? Yes, there are trend changes, but we're not going to cover right now. So let's just cover your question in the simplest way, which is a sequence of higher highs and higher lows has ended, right? And therefore, we can say, let's say, from the strictly, let's say, academic definition of an uptrend, we could say, well, that means that the uptrend is over. And from that strict definition, you are correct. But from the Elliott wave perspective, we actually don't see or don't define trends by higher highs and higher lows, or lower highs and lower lows. That's the typical definition of traditional technical analysis, and it's not wrong. In fact, let's look at it. If we have a 5-wave move up and 3-wave move down, this is exactly what we call an uptrend. This is, from the Elliott wave perspective, what we define the trend as up, where there are 5 waves up and 3 waves down. If prices were 5 waves down and 3 waves up, we would define this as a downtrend. Okay, well, what's the difference? In an uptrend, you have highs and lows and higher highs and higher lows and higher highs. And that's still there. So there is nothing wrong with that definition. Here we have a low, a higher low, a high, and now we have a lower low, but then we don't have a lower high, and then a lower low. We don't have the sequence, right? Therefore, there is nothing wrong with the traditional definition of trend based on a sequence of higher highs, higher lows, or lower lows and lower highs. But that is not what we consider a trend. And why not? Well, for instance, as I was explaining to Emil before, this leg could actually go here and be below this low here and still be an ABC. So we won't define the trend in that way. We will define the trend as a cycle of 8 waves. Now, here is the interesting thing. I erased the wrong one. The thing is that not every 5-wave move qualifies as an uptrend. Why not? Well, because the Elliott wave principle has a very, very strict way of, let's say, gouging if those waves are correct. And for that, we use rules. And those rules are so strict, they are the laws for us. And there are 3 rules, okay? And if the market violates those rules, even if they do higher highs and higher lows, it won't mean an uptrend for us. Okay, so let's see what the rules are. And this is the last lesson that you will learn today. And hopefully you will remember these 3 rules. The first rule, let me try to give you these rules in a mnemotechnic way so you memorize them easily. The first rule refers to the first leg, and that means that, let's go to wave 1. So wave 2 can never end beyond the origin of wave 1. In other words, wave 2 can go here, or here, or here. It doesn't matter where, but it can never go or travel more than 100% the distance traveled by wave 1, because then it is not a wave 2. And that is the first rule. So, first rule says wave 2 never travels more than 100% the distance traveled by wave 1. The next rule is that wave 3 can never be the shortest. Now, that doesn't mean that wave 3 has to be the longest, but it means that it can never be the shortest. And the third rule is for the next leg. The fourth wave can never end in the price territory of wave 1. So if this were to go down here, it goes inside the price territory of wave 1. Therefore, we cannot count this as a 1, 2, 3, 4, because that would not qualify as an impulse. In other words, it cannot qualify as an impulse, means that it cannot qualify as a trend definition, as a part of the 8-wave cycle that we were expecting. So, notice that in every drawing that I made, wave 2 never traveled more than 100% the distance traveled by wave 1. Wave 3 were never the shortest, and wave 4 never ended in the territory of wave 1. If we go to the real chart here, we can see that the same thing applies. Wave 2 did not end beyond the origin of wave 1. Wave 3 is not the shortest. In fact, wave 1 is a lot shorter than wave 3. And wave 4 did not end even close to the territory of wave 1. Therefore, this 5-wave move followed the rules, it complied with the rules, therefore it qualifies as a way to define the trend as up. Okay, so now let's go to here. Let's take this for example. Let's say that I draw something like this: 1, 2, 3, 4, and 5. What do you think? Should we expect now an A, B, C down? Should we say that we should expect a 3-wave down because we have 5 waves up? What do you think? And while you respond to that, I'm going to answer this question that says, we could even mark the wave 5 a few months before. How can we tell if mark pivot is correct? It's a very simple answer. Very, very simple answer. Yes, you could have marked the 5 here, right? How can we tell if this is correct? Well, because we know the basics of the Elliott wave principle. You know that if there are 5 waves up, they almost have 5 waves and 3 waves down. 5 waves, 3 waves down. 5 waves. And here's the problem. Does it have 5 waves? Well, the answer is no. You see, if you put the 1 here, the 5 here, you would have, take a helicopter view. You have from here, you go up, down, up. You have 3 waves. Now, if you put it here, where I put it, now you have down, up. Now you have 1, 2, 3, 4, 5. Let me label it with the proper label so you can see it. But how do you know when you are putting it in the correct place? Well, simple. Because they must follow the rules. And the first rule that we discussed, and I didn't mention it as a rule, was that each one of the waves that move in the direction of the trend must move in 5. But I did mention that those were the motive waves, and that motive waves always move in 5. Therefore, let's label these 5 waves. But you see, they are inside the one in circle, right? So they cannot be the ones in circle. They have to be the ones in parentheses that we called intermediate. So let's say that you start from the top, right? This would be the last wave. This would be the 5th, obviously. The 4th would be, well, the one before, right? Not that complicated. And the 3 would be the one top up before, right? That. And the 2 will be, well, keep looking down. That would be the 1. And obviously the 1 would be here. So now you have the 5 waves up. 1, 2, 3, 4, 5. And with those 5 waves up, now we know it is complete. If we put it here, we would be thinking, is that complete? And we would say, no, it has 3 waves only. If it has 3 waves, it's not complete. Therefore, it cannot be. That's the answer to your question. Okay, so let's see. Okay, I have many answers here, but I think I missed some. Yes. The question was if we should expect 3 waves down here. And many of you said yes. And the answer is no. Incorrect. And the reason why it's incorrect is the reason that the private 4T33 are set. Because the 3 here is the shortest. And with the 3 here as the shortest wave, we cannot accept this as a 1, 2, 3, 4, 5 and now think an ABC down is coming. In fact, with something like this, we can say, this is either an uptrend that is forming. For instance, this could be the 1, the 2, and the 3 is still forming, right? In which this one here was the minor 1, and this the minor 2, and now you have the minor 3. But the trend is still up. So you couldn't, with that third wave there being the shortest. You see? So that's the reason why the rules are so important. Because without those 3 rules, we cannot forecast. Let's have another example. Let's say that we have an up, down, up, down, up. Could we expect now, could we easily forecast here that there are 3 waves down coming? And the answer is, well, no. And the question for me to you is, why not? And let me give you a moment for you to answer that, because I don't want to miss so many of the answers as I did before. Okay, you said, Emil says no. The wrong wave, exactly, Marcos. It says that wave 2 is lower than wave 1, exactly. We broke the first rule. The first rule was wave 2 can never travel more than 100% the distance traveled by wave 1. Exactly, Tushar. Thank you so much. And Joseph. Can the awesome oscillator help with identifying waves 3, 4, and 5? Some indicators can help us confirm, but it cannot help us identify. It can help us confirm. And in fact, I teach a lot about the RSI, and I use a lot the RSI for specific confirmation purposes. So if the RSI doesn't behave in the way that typically behaves on wave 3s, then we don't think that wave 3 is complete. And Madhavand said no, because wave 2 is below. Frank also says no. Frank, 2 is below 1. Perfect. You guys have gotten it. Okay, perfect. Well, let's see if you can tell me now what can we expect here? Now we have 5 waves, and what is the next meaningful move that we can expect from these 5 waves? Can anybody tell us? And by the way, notice that this is in only one lesson, and you are already being able to say, no, we cannot predict that in that direction, right? So after 5 days of learning this, you will see how you will be able to forecast with certain degree of accuracy. Down, says Emil. Who else can tell us? So we can expect now a move to the downside, according to Emil, right? An ABC, said Madhavan, thank you very much. An ABC, in other words, 3 waves down. And why can we expect that? If wave 5 is complete, then ABC. That's the most complete answer. Because wave 5 should display these 5 waves. And they should be complete, and then we expect an ABC down. And that is precisely what we were explaining in the previous, with the previous question. So now we have a very clear forecast here. And why is that? Oh, because the market followed the rules. So let's see if you can tell me one last one, okay? One last one. Let's say that we have wave 1, 2, 3, 4, and 5. So how about that? Can we consider this an impulse, a correct impulse, and therefore forecast the next 3 waves down? If 5 is complete, we can see with Fibonacci retracement. No, we cannot. For 5 to be complete, we need to see 5 waves. It will usually form a W pattern. Now, those are different ways of analysis. When you combine them, you will mess this up. 4 enter the territory of 1. Thank you, Joe. Joe was correct. The Tushar as well. Number 4, this one, is overlapping with 1. Therefore, it cannot be forecasted that this is going to have an ABC down. Somebody says, with divergence. No. Trading with divergence is the best way to lose money in the markets. So don't do it. Divergence are good, but you have to consider divergence between what? The only divergence that is actually valid is the divergence between wave 3 and wave 5. And that means primary 3 and primary 5. If you trade with the divergence that occurs typically, let me erase this and you will understand something fascinating here. And many people trade with divergences, and that's why so many people lose money. You know, you have wave 1, 2, let's say wave 3 will develop in 5 waves, right? And now we have wave 4. So here's the thing. Between this leg and this leg, the indicators will typically move like this. They will make divergence. And people will go short only to discover that the trend is just in the beginning. You know, it's just starting. This is 1, 2, 3, 4, and 5. So they get surprised after. So don't use divergences in or without the context that Elliott wave provides you. Alrighty, so you learned today the main core pattern. You learned the 3 rules that make the core pattern actually function, because a core pattern that doesn't move in the proper way cannot be called the core pattern. This is not correct. Therefore, in order to have the core pattern, in other words, 5 waves up, 3 waves down, 5 waves up, 3 waves down, and 5 waves up, for us to be able to predict the next meaningful move to the downside here, all these waves will have to follow the rules. They will have to follow those rules. Wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. And the same thing must apply to this one here. So this would be this 1, right? This would be wave 2. So this would be wave 2. Wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest. And that same applies here, and here, and here. The same rules apply to all the components of the main structure, the main core structure. All right, so thank you for clarifying the basic principle. My pleasure. I am extremely happy to be here sharing with you this. And this is only the first lesson. I will see you tomorrow with a lot more, where we will explore more about impulses, we'll label more charts, and we'll see how this works in real markets. But for the time being, you need to memorize important things. Two things. Two types of wave modalities. Motive waves, they move in the direction of the trend. Corrective waves, they move in the opposite direction. Motive waves move in 5. Corrective waves move in 3. Motive waves are labeled with numbers. Corrective waves are labeled with letters. And then there are 3 rules that you must follow for those motive waves to be able to qualify as motive waves. And those are: wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest. And wave 4 can never end in the price territory of wave 1. Thank you all for being here. Now you understand the wave principle. Now you understand the basic principle of the wave principle. In the next few days, you will understand how to apply this to markets, how to trade with this, and how absolutely a must this must be for your trading arsenal if you are trading, if you are losing, and if you want to become or to break that cycle of losing and losing and losing. All right, guys, thank you very much. It was a pleasure to be with you here today. I'll see you tomorrow at the same time. Bye-bye for now.